Today we will be discussing our input on the accounting information systems in place in regards to the revenue cycle for Target and Kohl's department stores. So to get a better look at the performance of these companies, we will be breaking down the revenue cycle into 4 mini cycles, including sales order entry, shipping, billing, and cash collections. The objective behind each of these mini cycles is to ensure the revenue cycle is being operated reliably. This is extremely important to these companies. As the information is collected, strategic decision making is occurring for executives within Target and Kohl's. On the following slides, we will be discussing these activities and their potential threats in their respective quality controls.
The sales orders and the revenue cycle comes in multiple areas. I shall be talking about the customer orders and the credit approvals. Customer orders are the orders that are received from customers. Particular threats to these orders are people who make orders but have no intention of picking them up. There's also the threat of customization. How customizable should a order be allowed for the customer? Now, there are certain controls that are set up to contain these threats, such as pickup for fake orders. You have to be there in the store, otherwise it just goes back into the inventory. Does limit time that we can sell, but it does prevent the company from losing product. The other is prepayment. The prepayment, similar to Target and Kohl's, have drive on curb pickup. In order to get those, they need to prepay for their order. The other side of things are the credit approvals. These are where the accounts receivable for the company tends to grow larger. And obviously that's not good because companies want to get as much money as they can as quickly as possible. It also comes with the threat of non-payment. Anything after 30 days is generally considered less and less likely to be paid, and those accounts receivables will go down after a certain period of non-payment as the company writes it off. The controls for this are in the terms of interest, as well as, in particular for their credit card limits, it's to limit it. Target and Kohl's both have a card. Kohl's has their interest rate set at 30.24% interest rate. Now it changes from year to year, but that is the current one for 2023. And they have a general credit limit of $1,000 on the card. That limits their losses to $1,000, and any time after that 30-day window has passed, there is a considerable interest payment that Kohl's will receive. Target also has a similar card, though the limit tends to max out around $500 usually, but for them, it's based off your credit score or credit worthiness and other factors such as that. They keep their interest rate at 23.65%, which is understandable considering that they do a little bit more investigation on who they give out their cards to, unlike Kohl's, which offer it pretty much to anybody, so their interest rate is much higher considering that the risk that they'll take on of people not paying their card off when purchasing their products.
So let's take a look at the other two parts of sales order. That's going to be checking inventory availability and responding to customer inquiries. So let's start out with checking inventory availability. Some of the threats that come with this are excessive inventory stockpiling. This means that you just have way too much of one product that's building up in the back, and so they're losing money by not diversifying into other products to sell. instead they're stockpiling one product. And the other is kind of the exact opposite of that, in stock outs, meaning that the product's never in stock, so they're not able to sell it, and so that's another way that they could be losing money. Some of the controls would be RFID tags. This allows companies like Target and Kohl's to track their product much easier, especially with like returns and just their inventory in general. It tracks the specific product item instead of just kind of like the inventory as a whole. Another would be physical inventory audits. This is usually done by this and the sales forecast usually done by the accountants, where you're just going to actually go physically and look at what you have and also forecast the sales to see what inventory is likely to sell like in the coming quarter, and making sure that you have that product but not too much. And so the second part of the sales order would be responding to customer inquiries. Some of the threats that come with this is going to be poor customer service. We've all experienced this. This could be just answering wrong to the questions asked, or just being rude in general. Another would be fraudulent activities and impersonating. This could be done with sales refunds and impersonating people online, especially with online stores. Some of the controls that come with this could be customer service training. So Target and Kohl's both do this extensively. So this is going to be able where their employees can answer more accurately and in a timely manner. Another would be two-factor authentication. I know Target and Kohl's, along with a lot of other companies, are starting to use this. It's just a way to cut down on some of the fraudulent activities. And another thing that companies like Target and Kohl's use is going to be fraud detection software, and that's kind of the same thing, especially with their online stores. They're just wanting to cut down as much fraud as possible.
The second step in the revenue cycle is shipping to the customer. The shipping process consists of two steps, which are picking and packing the item and shipping the order. Kohl's and Target offer online shopping options that allow the products to be shipped to the customer's home or shipped for free to a local brick or mortar for in-store pickup. Both retailers offer a wide variety of products. Therefore, automated warehouse systems consisting of conveyor belts, computers, and barcode systems are necessary to ensure products make it to customers in a timely manner. When it comes to picking and packing the order, a picking ticket will be generated following the sales order entry. With this ticket, warehouse employees will use it to identify the products and quantities of those products. After verifying the products and quantities are accurate, the items and picking ticket are then transported to the shipping department. Both Kohl's and Target use radio frequency identification tags, or RFID tags, to track inventory items within the warehouse. The RFID tags can be read as the inventory is moved throughout the warehouse. This results in less time tracking inventory and allows more time to fulfill orders. Once the products have been transferred to the shipping department, they will verify the quantities identified on the picking ticket, as well as the sales order. The next step is for the sales order number, item numbers, and quantities to be entered into their online terminals. This will update the inventory and produce a packing slip to be shipped with the items. Once the packing is complete, the company then ships the item with their chosen shipping method. Kohl's and Target both outsource commercial shipping companies such as FedEx, UPS, and USPS. There are potential threats to this part of the revenue cycle. One potential threat can be theft of the products. Theft can be prevented by keeping products in a secure location with restricted access. To further prevent theft, warehouse and shipping employees should sign documentation at the time the products are transferred. Another threat can be inaccurate inventory or quantities. Since Kohl's and Target use RFID tags, it is unlikely that they will see a large amount of inaccuracy in their inventory.
The third step in the cycle is billing. Billing involves two steps: updating invoice and accounts receivable. Invoicing is simply an information processing activity which tracks shipping activities and records sales orders. We update invoice by updating customers' information through a sales invoice, which is basically just an invoice we send to customers to tell them how much money they owe the company. The second step is accounts receivable. Accounts receivable is updated whenever we receive a payment from our customers. Since invoice and accounts receivable are two different steps in the billing cycle, they have slightly different threats and controls. For example, some of the threats in invoice include failure to bill. If we forget to bill our customers, if we forget to send an invoice, then that could make us lose money. Not only that, but that also delays the process. That makes us lose time, and time is valued because we could be using that money for something else. Another threat is billing errors. If we do a pricing mistake in the invoice, we could get less money than what we're supposed to, or they could get overcharged, which might make them lose trust in us. Another billing error could be caused by our orders not being shipped. If an item is lost during the shipping process, then we must either resend more items to make up for the lost items, or we need to reimburse them. Either way, we would end up losing money. Not only do we lose money, but this also causes other companies to stop relying on us. Some of the controls in invoice include segregating billing and shipping. Why do we want to do this? Because let's say, for example, we have employees either both in Target and Kohl's, and they manage the shipping and our billing data. Then they could easily ship an item to themselves or to their friends and then credit their memos. We also use an ERP system to reduce this risk. What the ERP system does, it matches sales to shipping orders. That way we keep track of how many orders we're supposed to be shipping and how many sales we actually made. A pricing master file is used to retrieve the correct data to avoid pricing mistakes. And we also need to restrict the ability to change data. Like I said before, only certain employees should be able to change data, and that is only whenever they have the proper documentation or authority. Like I mentioned before, accounts receivable and invoice have slightly different threats and controls, but also some similar threats and controls. One of the threats in accounts receivables is when we make an error in updating our customer accounts. This increases the risk of cash theft and increases loss of future sales. Another threat is when we have one employee perform two different jobs. Like I mentioned before, we want to avoid having only one employee do two jobs because this increases our risk of theft. For example, here in accounts receivable, an employee might try to credit memos to write off certain accounts balances. A control that we can use to prevent this is the ERP system that we use in invoice. The ERP system here in accounts receivable would be used to match credit memos to sales invoice, and it should also require valid documentation to credit memos. That way, there has to be a specific reason to credit memos. Another control for accounts receivable is validity checks and closed-loop verifications to verify correct amount. And another control is the batch control. All customer payments equal all customer accounts balances. This makes it easier to check if there are any errors, and if there are errors in transactions, all the transactions should be re-examined. In accounts receivable, there are two methods used. The open invoice, which is when the payment amount owed is stated in the invoice. It's mostly used for smaller companies. The other one is the balance forward method. The payment amount is fixed monthly rather than updated throughout individual invoices. When using this method, we want to send our customers fixed monthly statements. This way, they can verify that we are charging them the right amount rather than waiting longer than a month. If we wait longer than a month, then there could be more problems.
The fourth mini cycle in the revenue cycle consists of the cash collections. Many may ask, what is a cash collection cycle and why is it so important to the revenue cycle? This is a cycle where the collection and process of payments are made. This could be on accounts receivable, this could be on credit, and this could also be with cash. It's important due to the recognition of revenue/activities and when payment is received or due. This is able to help a company track its inventory because as payment is made, the inventory is wrote off. But if the payment hasn't been made, this becomes a deferral for the company, deferral in revenue. This could put off inventory as you can't write that inventory off until payment is made. As well, this highlights a company's ability/responsibility to collect payments and process the cash flow. This makes them responsible for payment deadlines that are made and payment penalties, making sure that their cash is received on time and their line of credits. In the fourth mini cycle, the cash collection cycle, there are many threats to be considered. This includes diverted cash receipts, which is from unauthorized cash distribution or loss of funds, which can lead to fraud and embezzlement. And this can be an employee signing off on paperwork that shouldn't because they have the control over accounts payable and accounts receivable. This is why many companies put in place segregation of duties. This allows their employees not to have too much control over a certain department. As well, we do talk about that in a later slide. As well, unauthorized transactions. And this can be a transaction made without your authorization. And this includes stolen or lost debit cards or fraud, which can be from malware. We do talk about how to control this in a later slide. Lastly is cash receivables, which is misappropriated collection of cash from not collecting the payments that are made and required to be paid on a certain due date. This can result in under or overestimating your cash or receivables, meaning you do have more inventory than supposed on hand. This can leave you with a higher outstanding receivables, meaning your CCC is very high, and this can lead a company to not being able to transfer out its inventory. As well, in the cash collection cycle, there are controls. These controls are used to minimize threats. But first, let's talk about what controls are in the cash collection process and why do we use them. Controls are procedures that are set in place to limit the possibility of threats in the cash collection cycle. This allowing the company to not have to worry about many of the threats we listed before, the diverted cash receipts, unauthorized transactions, and the cash receivables. With this being said, we use these controls to establish separation of duty to protect cash and the receivables at hand within a company. And as well to increase the cash collections of payments to make sure payment is due upon the due date. As mentioned before, there are many control variables set in place to minimize the ability of theft within a company. As before, I did segregate these into two groups: cash receivables and receipts, as well as unauthorized transactions. Within the first group, many companies minimize theft by using the segregation of duties. This allows for someone in the cash controls not to have too much control over a certain portion. This could do with cash, accounts payable. It just allows the cash handling to be controlled not only by a single person within that company, leaving for more fairness and less theft. As well, many companies have financial electronic data interchange. This allows companies to submit paperwork/data or valuable information of its employees and as well as its shoppers into a data system, and allows it to be more accessed and visible. As well, they do internal auditing control, this allowing to make sure after every ship that it is audited, just to make sure there wasn't embezzlement of cash collections. Moving to unauthorized transactions, there is a cash flow budget set in place. This cash flow budget is set in place just to make sure for the failure of payment from its customers. This allows the company to have some fluff and not worry about the damages that late payments from their customers can have on their company. As well, they do have remote deposit captures to make the customers more liable for company purchases now, as well as signatures on credit cards to make sure that there isn't much fraud or embezzlement, and they can back it up with that person's signature. As well, electronic fund transfers have been set in place just so that it can be tracked back to accounting number and routing number from the purchase of that customer. This allowing for less fraud to be done and people not to say that their credit card was hacked, leading to less fraud and less losses within that company. The first scenario we chose was Kohl's. Kohl's is an American department store offering clothes, toys, and furnishings to families around the world. Kohl's is an omni-channel retailer focused on family orientation. Within these scenarios, I did pick real-life cash collection problems that were perceived within these companies. Within Kohl's, debt collection was a problem. With this, they did not disclose your statements on required collection payments. At this time, Kohl's third party did try to reach out to settle debt collections with its customers, but when doing this, they did not have any disclosure statements or required collection payments at the end of the documentation. This could lead to payments not being made, and it did. Kohl's did suffer a loss and had to pay out money in a lawsuit according to this. But with this, there are many control variables that can limit this theft and lead to the non-payment of debt collection. This could be signatures and disclosures attached to the bottom of these collection payments. The signatures would leave these people liable, knowing that they did sign up and that their payment is due at a certain time, and if not, someone will come and get the debt collection. As well, the third-party debt collector for Kohl's could have issued disclosure statements and who they were collecting debt for, which led to the loss and theft in Kohl's receivables. For scenario 2, we did choose Target. Target is a retail corporation that helps all families discover the joy of everyday life. Target is a general merchandise retailer. Target did suffer a data breach from a third-party company, Fazio Mechanical Services, and this was a cybersecurity data breach. This led to many of their customers' information of payment forms being stolen, which is a form of malware. This led to unauthorized transactions and theft within this company. Many of this could have been solved or even controlled and minimized by the monitoring/financial electronic data interchange. And a financial electronic data interchange is where many companies submit their data, and it allows it to be more accessible, but does allow it to be locked down. With monitoring being involved with this would allow the company to minimize the threat of their customers' information being stolen from a third party, allowing a data breach to not significantly affect their cash collection cycle, which does play a major role in many companies' revenue cycle, less affecting the loss on this company.